In our previous video, we introduced the concept of monetary policy divergence and saw what a massive influence it can have on the intermediate and long-term trends in currency pairs. However, there are plenty of short-term FX opportunities in line with policy divergence as well. One of the best ways to take advantage of short-term policy divergence trades is when central bank policy decisions or central bank comments sees markets pricing an even more aggressive policy path, whether hawkish or dovish, compared to what has already been priced in. What do I mean by this? Well, imagine that markets have been buying a currency in line with a very hawkish central bank that has been expected to hike rates or have been busy hiking rates. Now let's suppose that the markets were expecting the bank to reach a terminal rate of 2.5% in their hiking cycle. But then we have a dovish leaning central banker say in a speech that their stance is that the bank might need to consider getting to 3 or 3.5% in their current hiking cycle. All else equal, we would expect that to trigger more upside for the relevant currency. It is of course true that those hikes might not happen because it's only one comment from one central banker, but it could still be enough to create some short-term volatility that we can look to take advantage of. The economy might take a turn for the worse and mean that the bank never gets to those additional hikes as well. But the markets won't wait for that to happen before pricing in those additional hikes. Or in this hypothetical example, the markets won't wait for those additional hikes to take place before pricing in additional strength into the currency. Now, these types of hawkish and dovish surprises that occur in line with the market's bias can create some great opportunities. A good example of this was seen with the hawkish comments from the ECB members back in May 2022. At the time, the markets were already expecting a 25 basis point hike as soon as July, but the idea of a more aggressive policy move was thought to be off the table. Then we had these comments from an ECB member. It was the first ECB official to open up or mention the idea of a 50 basis point hike. These comments, compared to the ones just a few months before that, signaled a very hawkish shift from the ECB. Let's see what Not had to say and compare that to the recent comments. Gradualism is not a mistake, and the March CPI print is water under the bridge. We can afford to be gradual as long as inflation is seen as converging to target. Compare that to these comments where ECB's Not says that a 25 hike in July is realistic, but says a 50 basis point hike should not be excluded if the data next month suggests that inflation is broadening and accumulating. That's a very big difference in the tone and the language. Now look at the immediate reaction to these comments. Price jumped 20 pips in the first few minutes after the comments and was up over 40 pips in the 90 minutes after these comments crossed the wires. The pair we used to trade these comments with was Euro Sterling, simply because we were actually busy with the chart at the time and meant we could jump into the markets very quickly after we heard these comments over the audio squawk. Sometimes we do get lucky. It was a small and quick trade, just trying to capitalize on the short-term push higher, as the comments provided a high probability of a short-term appreciation move in the euro as markets started to price in a higher probability of a bigger ECB hike. Now, it's important to note that markets were already expecting the bank to hike, so it wasn't a new monetary policy divergence shift taking place. It was simply just an opportunity to take advantage of the short-term push higher in line with already hawkish expectations. As such, it wasn't a trade that we were trying to get greedy on and hold on to forever. It was simply a scalp trade as the news broke and worth anything between 20 to 40 pips. Now, these incremental shifts in policy rhetoric happens over and over again. And for someone that knows what to look for and how to compare to what has already been priced into markets, it can provide a constant stream of fantastic short-term scalp opportunities in the markets. Now, the other way we can take advantage of incremental or short-term policy shifts is when a bank that has been very hawkish or very dovish suddenly says something that doesn't quite match up with the dovishness or hawkishness that markets had already priced in. Now, our illustration on the screen explains this quite well, with a bank that has gone from hawkish to more hawkish to more hawkish, and then as a result of markets already pricing in so much hawkishness with the bar so high, the bank might disappoint the hawkish pricing if they underwhelm in their rhetoric or their decisions. A very good example of this is the reaction of the US dollar to the FOMC meetings in 2022 between March and July. The dollar's bias was clearly bullish looking at the trend. But notice that in all of these meetings, the US dollar pushed lower during the FOMC policy decision. What's even cooler than that is that majority of these reactions could have been predicted beforehand. In fact, we traded the US dollar lower in most of them. It comes back to the short-term policy shift. Notice that in all of these examples, we had a lot of bullish pre-positioning running into the FOMC meetings. That means that the markets were basically buying the dollar aggressively in anticipation of a very hawkish FOMC meeting. Now, the reason for the short-term sell-offs in the US dollar at these meetings wasn't because the bank wasn't hawkish. The bank actually stuck to a very hawkish tone and language in all of these meetings, but because the markets were priced so hawkish and so aggressively before the meetings took place, the bar for the Fed to surprise even more hawkish compared to what has been priced in was very high. Thus, at these meetings, even though the Fed was hawkish, they weren't hawkish enough to surprise the markets with their hawkishness, which led to very short-term downside in the US dollar as the bulls were slightly disappointed and underwhelmed by what the Fed had to say. Now, this is a very good example of this last column in our illustration, where the bank was still hawkish in their decision and tone and language, but just not hawkish enough to see a surprise hawkish reaction from the markets. A really important concept to always keep in mind.